Okay, so we are live. Thank you, David, for joining me today. So I just want to take a minute. I want to let David introduce himself to the audience. And so, David, just take it away. Tell everybody who you are, what you do, and all that good stuff.
So, good afternoon, everyone. My name is David Mizrahi. I'm the Director of Sales for FM Home Loans. I'm a loan officer as
Wait,
and
I don't. Okay, there you go.
sorry, and so I'm a Director of Sales for FM Home Loans. I've been in this industry for about 20 years. My bank's been around for approximately 30 years. For me, it's really just about making sure that the clients and the buyers are knowledgeable, understanding of what they're getting. It's not just about being pre-approved. For me, it's more about affordability and comfortability for a client to make sure that the monthly payments going forward would be comfortable for them and they're able to make them comfortably so they could have a quality of life. Our bank is a mortgage bank. So we are a direct lender. So there are no mortgage broker fees or third-party fees. So yeah, that's just a little bit about me. I started in this industry since I was 17 years old, a senior in high school. So I've been doing this more than I've been doing anything else in life.
Okay, so like I said in my preview to this meeting, I know everybody knows, or most people know about what it takes to get a pre-approval, but a lot of people don't know what happens after you get that accepted offer. So just briefly, can you just give us a little, update on what is it that you need in order to get pre-approved by your company or any mortgage company for that matter? And then we'll go into the other stuff about what happens after you get the accepted offer.
Sure. So, the first thing I always tell everyone is just to simplify, because everyone, when they think of a mortgage, they think of something complicated and they think of paperwork and things like that. And I always tell everyone, just remember the CIA. C stands for credit, I stands for income, A stands for assets. Those are the three things that banks look at in order to qualify for a mortgage. Everything else after that is just dot the I's, cross the T's. So, in regards to which documents banks ask for, always remember the number two. It's 2 years of tax returns, 2 years of W-2s, two recent pay stubs, two most recent bank statements, two IDs. Those are the documents generally what you need. Maybe a recent retirement account. If you're self-employed, of course, there's other documents like business returns, K-1s possibly. Someone that's retired, we would ask for pension, Social Security award letters. If someone is a person that is an investor, owns a bunch of properties, we would look at leases, things like that. But every file and every client is different. So every pretty much document request usually is a little unique, but the general one is always, the minimum is always tax returns, W-2s, pay stubs, bank statements, IDs. So what the banks basically are going to look at is just your credit. Look at your credit score, look at your payment history, look at the length of time you've had on your credit. But also credit scores are, in my opinion, one of the most important factors of the CIA. They're all as important as each other, but credit is the most important. And the reason why I say that is because someone that has a 20% down with say, 640 credit score is going to get a higher interest rate than someone with just 3% down with a 740 credit score. So credit score is going to be the number one driving factor of what interest rate you get. Now, the lower the interest rate, the lower the payment, so the more the affordability factor goes up. So that really helps. Now, so that's what the banks are going to look at. Now, one thing which is important to keep your credit scores up, one thing that you can do, which is very simple, is try to keep your credit card balances under 50 or even better, under 30% of the utilizations of the limits. So for argument's sake, if you have a $100 credit card balance limit, try to keep the balance under $30. Under 50 would be good also, but 30 would be the best. And that would give you the highest credit score. Now, the next is I, which is income, which is basically the affordability factor. It's how much do you make per month, what your mortgage payments are per month, with your taxes, your insurance, your credit cards, auto loans, student loans, anything that reports to credit. And you're going to divide that into monthly income. So the banks are going to look at that. Now, one thing that you could also use in order to help you qualify is a cosigner. So if your income by itself doesn't qualify, you could use a cosigner in order to help you qualify for the higher mortgage, and things like that. With income, the banks are going to look at your last couple of years of employment. If you're a salaried employee, if you're an hourly employee, if you're, if you're an hourly employee, they take an average. If you're a salary employee, like I actually had a client just 20 minutes ago before I got on the phone, they're an hourly employee up until 2 months ago, and then they went full time. So even though the prior year they made about 24,000 with their full-time position, they're making 1,000 per week, which is 52,000 per year. Just even though they just received it, I can give it to them day one. I just need a paycheck, and then basically just a verification of employment from their company. So if you did get a raise, don't think that you have to wait until a year or two to use that income. If it's a salary, then you can use it right away. But someone that's self-employed or a 1099 or something else, then you'll be using, or an hourly employee, then you'll be using an average over the last couple of years on the job. That's just a little bit about income. And then A is assets. Assets is basically the money that you need for the down payment, the closing cost, and possibly money you need for reserves. In regards to down payment, that's money you can get as a form as a gift. It's money that you have in your checking, savings, mutual, stocks, bonds. You can get a gift, a loan from your retirement account. So you could use that as well. If you have a life insurance whole term, you could use the money out of there as well. So it's basically anything that has an account. What I would love to make sure everyone understands is what you cannot use, right? Because any money that's sitting in an account you could always use, but now money that is cash, money that you're sitting in a safety deposit box or in your house, and anything else like that in form of actual money, is something you can't use. But there's ways to make it be used. Sometimes you could have a family member give you a gift, and you can give them back the money, the cash, or you could deposit it little by little. Because even if you're going into contract today, you're still not closing for 30 days, 60 days, depending on the timeline that the seller and you need. So during that time, you could put in 1,500 at a time, and certain increments at a time, which could then help you use that money. So I always tell everyone, if you have cash, do not deposit it. Feel free to reach out. We'll be more than happy to explain and explain to you exactly what to do and how to use it so that it won't hurt you or prohibit you from buying a mortgage in today's market. And if you like, I could then go into what the process is now once you go into contract.
Yeah, let's just ask one question. I had a question from a client maybe
Yeah.
2 weeks ago, and I know it's not part of CIA, but I want to ask the question because other people may have the question.
Yeah.
She said, do you look at length of the time where they living someplace prior to asking for a loan? Does that have anything to do with a loan
No.
at all? Okay, that's what I said, but I wanted to get it from the experts.
Yeah.
So
No, that
yes.
where you're living right now currently doesn't really affect the qualifications.
Okay, perfect. So
But it's
yeah,
good to
let's
also, we just put it part of the 1003.
Okay, so let's just talk about, like we said, like what happens after you say say we have an accepted offer, we're in contract. What's next? Because a lot of people don't know what's going on behind the scenes, and I think it's important that people are aware of it so they know what they need to do and what steps are being taken.
Yeah, so basically the next steps are, once you go into contract, what happens is generally you'll probably get an inspection done, get contracts in. Now, us as a lender, what we decide to do is just submit the file right away. We generally, when we pre-approve a client, we generally get all their documents right away up front. And then we already know exactly what they're qualified for. So once you go into contract, there's only three things that generally change on the entire contract, on the application. It's the address, the price, and the taxes. Everything else generally stays the same. So we submit the file right away. So while you're doing that, we're going to save some time just to speed it up, the process. But you're going to go and get something called your disclosure signed. You're going to get, the bank is going to send you over a copy of your application, a copy of your good faith estimate, a copy of your state disclosures, so that you could review everything and sign everything. Now, once you review it and sign it, now you can do this electronically. So, it's about 100 pages or 80 pages, but out of the 80 pages, there's probably only 5 or 10 that are relevant. But review them. It's always good to know. And any questions, always reach out to your loan officer. From there, you will sign your disclosures. Once you sign the disclosures, we then order your appraisal. At that point, the appraisal is basically an opinion of what the value of your home is based off of the recent comps, comparables on sales within the area that is similar to your type of property. Now, at that point, once the appraiser goes out there and inspects the property, at the same time, you as a client are getting updated pay stubs, updated bank statements. When you go into contract, you're going to give a down payment check. That down payment check, let's just say for argument's sake, you're buying a home for 500,000. The attorneys are going to request you to give them a check, say, of 5%. So that's 25,000. So in the contract, so when you give that deposit at the time of signing the contract, we as a lender are going to request a copy of the canceled check, which is the cleared check once it deposits, along with a copy of the bank statement showing the deposit being withdrawn from your account, because we have to credit your loan with that money that you already put into the transaction.
Okay.
Now, at that point, once we get updated documents, the processors are going to update your file and then send out a request of a verification of employment to your employers, which is basically them stating when you started in the company, what your annual income is, or what your hourly income is, how many hours approximately you work for a week, you're likely to continue, just a bunch of just standard information that the bank would request. They would fill that out and get that over. We would request something called transcripts, which is basically us confirming the tax returns you sent are legitimate. We get that from the IRS, and all the numbers are accurate. Believe it or not, back in 2008, this why we needed it was because a lot of people would just send tax returns and just put some numbers in and send it over. So that's why the banks request that these days. And then at the same time, we would be then processing the loan, putting the file together and preparing it for the underwriter so that they could review it and give a commitment. Now, what is a commitment? A commitment is basically the bank committing to you that they're going to give you the money for the mortgage. And basically from there, it's an approval. It's you receiving your copy of your approval, and you will send that copy over to your attorney. Because at that time, once your attorney receives a copy of the approval, the commitment, they're going to order a title for you. And what a title is the best way to explain what a title is basically it's a credit report for the house. Basically, you have a credit report on yourself, how you make payments, if you have any judgments, foreclosures, bankruptcies, all your payment history, how you are as a payer. The house has a history. If there's any judgments, or liens against the home, if there's any violations against the home, if it's clear, everything is perfect against, open permits, things like that. So now the title company that your attorney chooses to work with is going to insure that title. So if something was supposed to be there and they didn't insure and they didn't find it, and you bought the property, and then someone comes after you saying, now you own this home and you have this lien against it, but you have this title company that insured it, then basically the title company will be on the hook for that lien for you. Now, at that point, when you get a copy of the approval, you will get something with what they called conditions. Your file is approved, committed, but I need these conditions in order to clear it for closing. Okay. So basically, the underwriter will ask for a copy of your sign the commitment. You have to pick out an insurance company. We probably will need out recent pay stubs. We'll probably, recent, anything that needs to be updated, because when you're closing, you need to have the most recent pay stub. If you didn't get a recent bank statement until then, and it's within the same month, then we don't need that. And other things like that. So sometimes it's really just sign the commitment, recent pay stub, title report, and then sign a couple of things, and you move on, and you could clear your loan for closing. Now, once the attorney gathers all the documents and you pick out your insurance company and they send that over, and you gather the conditions in, and we send that over to the processor, they will review everything for you. And at that point, they will then plug all the insurance numbers in, the title numbers in, the tax, the tax bill, the insurance bill, all the bills in to the system. And then at that point, they're going to they're going to submit the file over to the underwriter for clearance to close, to review everything, to clear the file to schedule for closing. But at the same time, they're going to send you a document, a disclosure called a CD. A CD stands for a closing disclosure. Basically, what you receive is the numbers, approximate numbers. They're pretty much almost, pretty accurate. Besides, sometimes the taxes could change depending on the title content, the tax content when they do that within the few days of closing. And if any titles, tax are due, they collect that at the closing. And they send you out the numbers of the amount that you will probably need to bring to the closing and what the breakdown of the fees are. Now, once you receive that document and you sign that document, then you could close 3 days later. So for argument's sake, today is Wednesday. So if you receive the document today, Wednesday, Thursday, Friday, you can't close on the weekend, Saturday or Sunday. So you can close on Monday. If you received it on Thursday, Friday, Saturday counts as a business day. Sunday does not count as a business as a day for that 3-day right to for the 3-day waiting period, and then you can close again on Monday. So that's and then from there, the underwriter reviews the file, then they clear the file. The bank attorney, if it's in the state of New York, I know that you have a big following in New York and New Jersey. So if it's in the state of New York, the bank attorney will reach out to the buyer's attorney, and then the buyer's attorney will reach out to the seller's attorney and then all the attorneys will get their client's timing. And then they would schedule a time and a date for the closing, and then the bank attorney would go there with the documents and the checks, and from there they will, and you'll bring your check, and from there the money will go to the attorneys, and then the attorneys will then disperse the checks to everyone. So you don't have to bring 20, 30 checks, which I get often, how many checks do I have to bring? Title company, taxes, this company is, no. You just have to bring one check. They pool the money together, and then the attorneys write out all the separate checks one by one to everybody, so you don't have to deal with it.
Okay.
And then in the state of New Jersey, the title company would pretty much coordinate everything with the attorneys.
Okay.
And then you get your keys.
That's I love it. So you don't have to close in 3 days. You just have 3 days. It's your waiting period.
Yeah, so exactly. So like I have a client right now that the seller is kind of a tough to deal with, to put it in a nice way. They're just not communicating with us. And they're not, because they're waiting. I don't know. They're just having an issue, I guess, getting their own mortgage. They don't want to close until they get their mortgage. So we're on hold. So basically what I did for this client was I sent out his CD already on Monday. Because if now I sent it out on Monday, Tuesday, Wednesday, let's just say today at 3:00, he finally says, I want to close and only on Thursday, because he did that to us last week, which was and then he couldn't close. So, but if he wants to do it this time, and this time he could actually close, we want to be prepared. So we want to make sure. So basically, we sent out CDs, and we're just on hold right now, waiting for them to clear the file, to schedule the loan. And the minute they schedule the loan, we could then send the file to the closing department, and then they can prepare the documents and send it out, and they could close.
Okay.
So we don't have to wait the 3 days after that.
Okay. So there's another question I had. Is there anything different in that end process if it's a co-op, or is it all the same no matter if it's a private house, co-op, or a condo, whatever the case may
Great
be?
question. No, great question. Really great question. So on a co-op, so there's 2 approvals on a co-op. When you're getting your mortgage, you have to be approved for the loan, the mortgage you get, but there's also an approval on the building. So the bank is not only going to approve you, they're going to approve the building. One of the great things with us is that we have a co-op and we call it the vertical department, anything that goes up, a condo co-op. So we have a department that basically deals with the co-ops and condos. So when you're purchasing a co-op, basically, if it's approved, some co-ops are approved with, Chase or Wells or Citibank or Santander or Caliber, and, they're not approved with the other. The good thing with us is if they're approved with any of the big banks, we're approved with them, we can do the loan. So we just have to basically underwrite in-house. Okay, it's approved with this bank. We can then underwrite to those guidelines and close it for you. So now you don't have to go and call 6 banks to find out where they could do it. The rates are very competitive to them, so they'll be the same pretty much. And then the timing of the efficiency will be better, which is great. But the thing about it is that we have to look at the building. So what are we looking at? We're looking at the co-op financials, the master policy, the insurance policy. We're looking at basically the strength of the building. Right now, we're dealing with a building where I have a client that is as qualified as possible, putting down 35%, has a 740 plus credit score, income 100 and something thousand, 130,000, on a property that's about $380,000. Very, very, very qualified. But the problem is that when we got the questionnaire back from the co-op is actually in foreclosure.
Oh.
The co-op isn't making their payments on things. They had issues on things. Now, the one good thing is that the issues they had was from about 3 months ago, and they didn't. The person didn't update the questionnaire, which then we have to update it. But the banks already knew that because it was on the deny list. So what we're doing now is we got all their updated documents. They refinanced the building itself, had their own mortgage, so they refinanced it. They were on a mortgage that came due and they needed an extra month to close, so they were in foreclosure. When you have those type of mortgages, you have a certain amount of time. They have a balloon mortgage. You have to close in certain times. That's not for a mortgage that residential a buyer would get on one family, two, but when you're buying an entire building, there's different types of mortgages. So that was there. And then they came and they gave us all the documents. They gave us the close. So now we're actually going back to them and to see if we could turn that denial into approval and close the building. So, but generally, if there's no issue, we submit it in, we get a copy of the questionnaire, the master policy, the budget, and things like that, and we submit it over to get the approval.
Perfect. Perfect. So another thing I'm running into a lot, and not a lot, but is the difference with a condo and a townhouse and FHA loan as opposed to a conventional loan. So I was made aware that there is a list of buildings that are approved for FHA loans as well as VA loans. So I don't know.
Right.
I guess there's some information people need to be made aware of regarding that, because if you have an FHA and you want a condo or a townhouse, it might be a little more difficult than if you had a conventional loan. So, speak to that a little bit.
Yeah, so great question. So if you're buying a condo, so FHA, when you're getting an FHA mortgage, FHA mortgage is for a condo. It's not for a co-op. You can't get an FHA mortgage for a co-op. You can only get it for a condo, 1, 2, 3, 4 family home. So now the problem with a condo is not the problem with a condo. The guidelines with a condo, I should say, with FHA is if you're getting an FHA, if you're getting purchasing a condo with an FHA financing, the building has to be approved with FHA. Now, the FHA came out with a new rule just about a month ago that we could try to get an FHA spot, a condo approval. So, which is a little bit harder, but the building has to meet all the criteria of FHA in regards to owner occupancy, default rate, and a bunch of other factors. So on a conventional loan, there isn't as many factors. And also, if you're putting down 10%, there's something called a spot approval, which basically means that a limited approval, which means that you don't really have to go through all the qualifications and you can get a limited approval, which and close a lot quicker. So with a conventional loan, you'll have a lot more avenues to purchase a condo. On an FHA loan, what I usually tell my buyers and my relationships, my realtors, is that they should go to the FHA approved website, click in the zip code or the city where they're looking to purchase, and then look at all the approved buildings and look at those buildings only. Because there's no point if they only could qualify for an FHA loan to look at all other buildings unless they're able to, qualify for it. Because why look at property that you can't get? It gets your hopes up for no reason. So we will, help you with that. Now, sometimes, which I have right now, where I have a client where they were going with an FHA loan, but they had great credit, great income, and we were able to show them how they can get a 5% down or a 3% down on a condo conventional loan, which then helped them open up the pool of condos they could go and look at. So there are sometimes ways to do it, because a lot of banks, when you're putting down under 5% or a low down payment, they push you to, they only have the programs to go with a FHA program, when we sometimes have programs where they could go to a conventional loan.
Okay, so I had some questions. They're not showing up on here for some reason. So I went to Facebook so I could ask the questions. So Ashley Harris had a question. She said, if someone finds a new job Does this affect them getting approved? I work in the same field, but took another job in the same field with a different company.
Wow, that's the third time I had that question this today. It's a very common question because in today's market, the job, everyone looks at the job market. There's a need for experienced people. So a lot of people have been moving around a little bit, getting great promotions. So I always tell everyone is if you get a job change in the same industry, but you're getting, before you were making 80,000, now you're making 90,000, and you got and you got a job letter, an offer letter stating that, and you get to the work, and you get to your new employment, and you get a paycheck. We get a copy of the paycheck with the job letter, and I can use your new income, your total new salary, the higher salary. We're not going to average it out. As I was telling everyone before, if you get a salary increase, I can use your salary increase, that high number. If you went from 60,000 and now you went to 90,000, you went up a third of your income, or half of your income went up, 30,000. So basically, in that hypothetical, we get a letter from your managers or the owner of the company saying, yes, they went from part-time to full-time, and now they're a manager, and now they're, managing a sales force for us, or the store, or whatever the case may be. Then I can use that income, and I'll be able to give you credit for the entire new salary and use that for the pre-approval. Great question.
Perfect. So I think this is a piggyback off of that question. So the question was, how much time do I need to be on a job? Also, what if I was out of work during the pandemic last year? Am I able to purchase a home? Well, I think this is a separate question. So let's just go with those two. How much time do I need to be on a job? And what if I was out of work during the pandemic last year?
So great questions, because definitely the second one. I mean, that's something that a lot of people are going through right now, and that's something that's a serious matter in a lot of households. So that definitely is a great question as well. So how long you need to be on the job? Always. So basically, to be on that job is generally, it depends on everything. It's generally up to minimum of 30 days, generally, depending on the situation. But really, the best question, the way to answer is you need to have employment for 2 years. So let's just say, I'll give a perfect example of a client right now that was working 3 part-time jobs over the last couple of years while they were going to college. Now they got their degree. They're working a full-time job, and they just started receiving it literally over the summer, because they just graduated in May. So basically, we have a 2-year work history. Now we showed that they graduated, and now we showed that they're receiving a new income. Now, as we just said, you could always use the new salary, so you could use 100% of it, even though they're working part-time, to making maybe 20% of what they're making now, because their income is in the 6 figures, and before that, they were nowhere near that. So basically, they have a 2-year work history. So just being at the new company, in that situation, basically, we would just need the job letter, get the paychecks, and once you have that, you could use that income right away. As long as they have a 2-year work history. I have a client right now where I couldn't give them a mortgage because of the fact their wife, or was the husband, their spouse, basically just came to this country just a couple of years ago, or a few years ago, and they just started working in America. So they didn't have a 2-year work history in this country. Even though she has a 2-year work history outside the country, she doesn't have it here. So I wasn't able to use it. Now, in the same breath, I will say is, if someone's working for Apple, which I have a client right now, who's working outside the country, we could use that income, because we could show, especially, they're filing tax returns in the United States, but they're out of the United States. We're using that income to qualify. So that's something you could use as well. Now, the second question was, with the new job with the pandemic. So basically, you could use the new income. And let's just say, with the new employment, you're a part-time employer. You're a part-time employee. You've been there for 6 months. Your income at 6 months is $30,000. So basically, the bank will take your 6 months and average it over the 30,000 and say that's what you're making. You're making $5,000 a month. So now your income is $60,000 a year, and they'll give you the credit of the $5,000 a month. Now, again, if if it's a salary, and you just started you were out of work from the pandemic, and you're on unemployment, and now you're back to a salary, and your income right now is $72,000 a year, $6,000 every month, then the bank will give you the credit with the 72,000.
Wow. Because I had a client that the wife wasn't working during the pandemic, and I was told that they couldn't use the salary that she has right now. So that's a little different. That was a different
100% you
company, of
could.
course. Right. That's a different company. And they came to me with a loan. So we'll talk later. We'll talk later, David.
Okay.
So
And just
my
to let you
other,
know also is, let's just say you have a client, which is, I'm sorry to cut you off. Let's just say you have a client that's been working now for 6 months and they were out of work for a year and a half. All the bank will do is go back to the prior, they've been working for 6 months. They're out of work for a year and a half. Now the bank needs to get the 2-year work history. So now they just have to get the last 6 months. I have a client right now. She was pregnant. She had 4 kids. She was out of work for 7, 8, 9 years, whatever the case was. She's back to work now for 12, 13 months. Now, what I did was I'm getting her employment from 10 years ago to show she has a 2-year work history, getting an explanation of where she was over the last couple of, bunch of years in the employee world. And then basically show that she's back, and with the VOE and a letter and everything stating what her income is, I'm able to use her income. So those are clients that do qualify as well, where I hear a lot of the times where they don't, because they don't have a 2-year straight employment. You don't need it.
that's good to know. So the next question was, what if my car breaks down during the transaction and I need a new vehicle?
That's great. The famous, I got a new car after I got my contract. Uh, so, okay. So it happens very often. I mean, I get this question from a client at least once a month. And I always tell the clients, if you need a new car, get the car. But first thing is, give me the numbers of the car. Are you trading in this car and you're getting a new car? So now you're trading in this $460 car. Are you getting a $760 car? Or are you getting a $460 car? Because if it's $460, it's not really going to affect anything, because $460, you qualified before, you qualified now. But, I have a client, which I'll never forget. I won't say his name because we're on live, and God forbid someone's seeing this. But if you are seeing this, I'm talking about you. He's my friend on Facebook. He's now. But he he's buying a property. He got a car. So I told them, X, Y, and Z, sir. Don't, that's it. No more things. We're very close, and your DTI is very close now. He co-signed for his daughter to get a car. I figured out the loan. I'm like, wow, you got to pay off this one credit card. Now you qualify. Don't do anything else. 2 days before the closing, he co-signed for his son to buy a car, and the banks check. They do a soft pull. They don't run your credit again, but they just look to see if you obtained any new credit since the last time we looked at your credit. And I called him up and I said, are you serious? You got a new car? And he said, well, how'd you know? We're closing. We're scheduled. The file was cleared. I said, but I told you we're checking and everything. And he said, but I didn't think you guys really did. I said, well, really? Now, unfortunately for him, he had no choice. He had to pay off one of the cars. He had to buy them out, get rid of the loan, and
Wow.
actually go take money out of his retirement account to buy the house. He had no choice. He was literally scheduled to close, and he had to do that. So the point of the story is if you don't need it, don't get it until after. I had one of my clients who called me up the other day and said, I want to go and get all the furniture. Can I go buy it now? I said, if you buy it now, you qualify. Your income, your debt to income ratio is great. What will we need if you do obtain this? I will need a copy of the statement from the new creditor, so I could have put it on your credit report. So if you're looking to close in the next couple of days, it's not going to happen, because now you have to get us a statement. We have to send it to the credit bureaus, and they have to update it, which probably takes another 24 to 72 hours, depending on their capacity at that day. And then we would get that back, send it back to the underwriter to review it again, because now your debt to income ratio goes up, and they have to redo all the files, all the numbers, which, even though we're talking about maybe $100 debt, believe it or not, the entire file has to be redone. And
Okay.
then they would send it back to the closing department. So if you don't need it, don't get it. But if it's early in the process or in the middle of the process, you need the car, go get the car. But always call the loan officer, and, just to make sure the numbers are. And if you do, just keep the documents, keep the copy of of your contract with the new car, and then call them up and ask them for a copy of the statement, so we can add it to the credit bureaus right away. So it doesn't really stop anything or hold anything up for you.
Okay. So that's the same as if you're leasing a car, and you want to, and then at the end of your lease, you want to purchase the car. Is that basically the same, or is that
So it's the same thing as, so basically it's okay to do it for sure because it's the end of the lease, which means you're getting rid of the payment. But what does that payment go to? And that's the only question. You know, I have a client right
okay?
now
So you
that
have to
actually
figure that out.
extended his
Okay,
car. Yeah, he extended his car because he said, you know what, I'll get a car in another. I mean, right now is a horrible time to get a car, which he learned very quickly. So I told him to go and, you know, extend the car. Now we don't need any documents. And then I told him whenever the car market gets better, or whenever the, you know, or whenever we close, and do whatever you want, because the day after you close, we're not looking into you anymore.
right, right, right. Okay, so I
But the
didn't have
day
any more.
after you close,
Yeah, the day after, not the day
the day,
before,
not the
because
morning of. Don't go and buy it the morning of, but the day after, please.
I had a story. It wasn't my client. It was another colleague's client. He got a new credit card in order to get tires for his car, and the closing was delayed because he went and got that new credit card. It was only delayed a couple of days, but still, it was delayed. You
But
know,
still, you know, anything could happen in those couple of days.
right,
So no reason to play with it. And you know, when your files, I always say, when the file's ready to close, close. You never know.
right. So I didn't have any more questions on Facebook. I don't know why the questions are not popping up here. But is there any last minute any information you wanted to share? How to reach you? Because I mean, you give a lot of valuable information, and people may have more questions after the fact.
Yeah, so feel free to call me or email me. I guess my cell is the best, and I'll give you my email as well. My cell number is, and again, my name is David Mizrahi, Mizrahi, David. I always say just put David Mortgage because everyone doesn't pronounce it the right way anyway, but most people are these days actually. But David, 917-597-0870. Again, 917-597-0870. And my email is my initial and my last name. So it's D as in David, and then Mizrahi, M as in Mary, I as in Isaac, Z as in zebra, R as in Renee, A as in Apple, H as in Harry, I as in Isaac, at FMM, which is First Meridian Mortgage, so like Frank Mary Mary.com. So any questions, feel free to reach out, email me, call me, text me. I'll be more than happy to answer any questions, and make sure you're set up the right way, or if you're an agent, make sure that your client's set up the right way. So when you're going out to look with them, they understand the numbers up front, so they're managed the right way, so that their expectations are put, because at the end of the day, it's really just about the client's expectations and making sure that they're really where they want to be, and with the comfort zone and the affordability factor in regards to the numbers. Because, you know, everyone knows my saying, people lie, numbers don't. Get the numbers.
There you go. Thank you so much, David. I will put your information in the comments
My
on
pleasure.
Facebook as well, and I'll put it in the description on YouTube.
Thank you. I appreciate that.
And I thank you for your time. And we will be doing some more talks like this. But if you have any topics you want to hear about, just let me know, and we'll try to get an expert on to give you that information. So thanks again, David. It was great having you. We'll talk. We'll talk to you
My
guys soon.
pleasure.
Bye bye.
Pleasure was mine. Looking forward. Bye bye.